I'm sure you have all heard about Beyond Meat, ticker BYND, and how the stock is exploding in price. In this video, I will explain why the stock has risen so much today and if I would buy, hold, or sell at this price level. So before we hop into the analysis, just in case you don't know anything about Beyond Meat, essentially they're a company that produces plant-based meat alternatives. They sell hamburgers, sausages, bacon, and many more products. The stock was actually particularly popular in COVID, where the market cap hit $156 billion, trading at nearly $200 a share. And fast forward to today, and the chart on the left is trading at $1.28, which is up nearly 100% on the day. The chart here on the right is the stock's all-time chart, showing that significant decline since COVID. So what happened? Why is the stock up so much today? Well, the stock has been plagued with over a little over $1 billion in debt, and that debt was convertible, meaning that at a pre-arranged price and share level that they can swap the debt for equity, and that's what's been done. So they got rid of 96% of the debt on their balance sheet and converted that into shares at about $3 a share here, significantly diluting shareholders, but it gets them to escape out of bankruptcy here, with debt pressing down on you and having to make payments when the company's not making money like this. Could definitely have shut down operations. So being able to convert that debt to equity, even at the cost of diluting shareholders, is very promising and gives the company a little more life and runway ahead of them. And in addition to getting that lifeline in the sense of being able to convert that debt to equity, there was also a major buy-in by Context Capital Management. They bought 20 million shares today on 10/20. Since the company was able to get their debt off the balance sheet through converting the bonds to equity and having Context Capital buy in, it has caused the stock to spike today. We're up nearly 100% on the day. Now retail investors are eyeing up the opportunity on the stock for a short squeeze. So here are some of the stats on short selling for Beyond. There currently is 39.5 million shares sold short. Previously, it was 31 million for an increase in short selling of 26% from the prior month. The short selling represents 61% of the float. Since everyone sees this potential short squeeze and everyone and their mom is running to purchase the stock, but what's happening? People are reporting and they're having trouble buying the stock on Robinhood. They're being limited in the quantity and amount they can buy of Beyond stock, and they're even being restricted on Reddit from mentioning the ticker symbol. This all feels eerily reminiscent of GameStop. So, what exactly happened with GameStop? Well, GameStop was on the verge of bankruptcy, just like Beyond Meat. People started shifting to digitally downloading games to their PC, Xbox, and PlayStation rather than actually buying the physical discs, which is GameStop's whole operation. People were worried about the future until some DD was done on the stock and they were able to prove the company wasn't just dead yet and they had some more runway to go. When this happened, retail started to pile in and force shorts to cover, rocketing the stock price, as you can see here, to $80, which was awesome. The stock now trades at $23 and it's never quite got back up to the short squeeze price of $80. So, why am I telling you all this? Because I think it's wise to get in and get out, if you're even touching this at all. Just please don't be the guy who bought at 80 and is still holding to today while the broader market is up nearly 100%. Just remember, quick returns in the market are often followed by slow losses. All right, so unfortunately, now the fun's over. Now's where I start to kind of roast the company and talk about their fundamentals. Why? Because I'm a value investor. I believe the value of a company today is the present value of its future cash flow stream. period. Nothing else to it. So when I buy a company, I want to see revenue increasing and a profitable company. When I look at Beyond's income statement, their revenue was really strong in 2020 and 2021. They were at the height of COVID, and alternative plant-based meat was brand new. People didn't know what to think. Is it cheaper, healthier, better? What's it taste like? And the company saw amazing growth rates at 37% in 2020 and 14% in 2021. Then reality sunk in. Plant-based food does not taste good at all. And you can see the demand falling off, where revenue dropped in 2022 by 10%, then 18% in 23, and 5% in 24, and another 5% in 2025, to the point where the company has decreased revenues by 25% in 5 years. And projections are not looking promising either, which we'll touch on in a bit. And just to show you guys they're unprofitable, here is their cash flow statement. I'm a fan of cash flow, net income, and EBITDA are more accounting ways to measure profitability, but the statement of cash flows will actually show you the net cash that came in through the door. And even the first part of the cash flow statement, the cash from operations, which you can see here, has just continued to increase. You can see in December of 2020, they had negative 40 million in cash from operating activities, and now they're at 110 million negative. Not what you want to see from a company. They're going to constantly need to pull on debt or get equity injections and dilute shareholders further. This is from the company's most recent quarterly earnings, and the management is giving guidance or, a little bit of guidance. You can read along with me here. The company continues to experience an elevated level of uncertainty within its operating environment, which as in management believes could continue to have unforeseen impacts on the company's actualized realized results. In light of this uncertainty, as previously announced, the company is not providing full year guidance and is limiting its revised outlook to the following. And this is all we have. In the third quarter of 2025, net revenues are expected to be in the range of 68 to 73 million. So what can we do with that? Well, let's just take the high end, 73, and let's times that by four because this is one quarter's worth of work. So now we have about roughly $280 million. I guess you want to be exact, $292 million in revenue, which is well below where they're at. I mean, that's projecting another year's decline in revenue, which is just what you do not like to see on top of an already unprofitable company that was just burdened with debt and is now diluting its existing shareholders. So for me, I'm not buying the stock. If you were in this stock for some reason and you were lucky enough to get this 100% break today, sell and look for something else. I mean, the revenues are collapsing. The company's never been profitable. They're diluting existing shareholders. I don't see a great runway or reason for to buy into this company right now. So one of you guys let me know in the comments what you think. If you think I'm wrong, please let me know. Let me hear a bull case. I'd love to hear it. As always, hope you learned something and take it easy, guys.